for Eureka Equity Partners here in Philadelphia. Wanted to also, I'm the co-chair of this year's M&A East conference. I'd like to officially welcome everyone to M&A East this year, and also to our virtual ballroom and the Deal Lounge. After weeks of hard work, this hopefully is together. I'd like to thank quickly the steering committee for all of their hard work as well, and to the entire ACG staff for pulling off an M&A East that is in quite trying times, of course. This year's M&A East is organized around 5 core middle market industry sectors: business services, consumer and e-commerce, industrials, healthcare services, tech-enabled services and SaaS, as well as special situations. Each floor of our conference is organized around specific verticals, so you can make more meaningful connections. You're going to view the directory on the right of your screen. That'll take you to the different floors where each of those different industry verticals will be centered. Our content is also industry focused, as you'll see. And this morning, we're starting off with a program on what consumer behavior is going to look like in a post-COVID world. And with that, I'd like to introduce our moderator this morning, Mr. Craig Lawson. He's Managing Director with Cowen and Company, formerly a founder of MHT Partners, which was recently acquired by Cowen this month. And now I'll turn it over to Craig.
Thanks, TJ. Again, I'm Craig Lawson. I'm a managing director with Cowen and Company, which is a full-service global investment bank. And per TJ's comments, I'm a recent arrival at Cowen. Up until about 3 weeks ago, I was a co-founder and a managing director at MHT Partners, which is now a part of Cowen. And in terms of where I spend my time, as I have my entire career, I focus on consumer companies in the middle market. And apparently, as all the other learned professionals in this space, we're busy this morning. The folks at M&A East asked me to moderate this panel, and I find myself sitting here and am delighted to be here. So without further ado, let me introduce our panelists. They are in alphabetical order as follows. We have Kristen Ferris. Kristen is a partner in the Boston office of Morgan Lewis. She's an experienced corporate transactional attorney focused on the M&A and private equity investments across various industries, most notably for the purposes of this panel in the consumer and retail space, but as well in the life sciences, financial services, and technology arenas as well. We also have with us Oliver Nordlinger. Oliver is a co-founder of Monogram Capital, which is a growth equity firm based in LA that has a flexible mandate to invest across the full spectrum of consumer subsectors, stages, and structures. We also have with us Eric Roth. Eric is a partner at MidOcean, which is a New York-based private equity firm focused on the consumer and services spaces. Previously, Eric headed consumer retail at Lazard Middle Market, and before that, he was an attorney at Dewey Ballantine. And then rounding out the crew, we have Pat Segru. Pat is a partner at New Spring Capital and has co-founded the New Spring franchise strategy. He's got over 25 years of C-level operating experience. Patrick focuses his efforts on investments in lower middle market franchise-focused and company-owned multi-unit concepts with significant growth potential. So before we launch into the questions, again, I just want to thank the folks at M&A East and in particular our panelists here. So to kick things off, we're obviously living in some highly unusual times, which is probably putting it diplomatically, where the situation remains fluid and the rules and guideposts that one perhaps used in the past to not only generally live their life, but more particularly to evaluate deals in the consumer space, perhaps no longer apply, or to the extent they do apply, they apply with a large variant now in place. Our panelists, in addition to each and all of them being a consumer themselves, as we all are, are involved in the consumer deal world day in and day out and bring an interesting and varying perspective, ranging from the lower middle market principal investing side of things, which Oliver has covered at Monogram, to the larger cap side of things with Eric at MidOcean, from an operator perspective, in the case of Pat, to the legal side of things with Kristen. And given that the topic of today's panel is post-COVID consumer behavior, paradigm shifts versus normalization, while it is obviously focused in its nature, it's also appropriately titled such that it allows us to take this conversation in a number of different directions. And so while I could really start this panel off by asking any one of our panelists the initial question, I'm going to direct it initially at Oliver, given that Monogram has been particularly active over the past 6 months or so, having made 3 or 4 investments during the time period. And so, Oliver, the question for you really is, any thoughts on how one approaches the topic of consumer behavior and adjust for any abnormalities that we're perhaps seeing and experiencing in the times that we're living in?
Yeah, Craig. So, I mean, we have found ourselves really active during this period. Just during the summer months, we completed 4 new platform investments. And, really the first initial hurdle for us was removing the in-person element of working with management teams. So, initially we were focused on pre-existing relationships and pipeline. How do we get comfortable with Zoom and, forming relationships that way? But, out of the necessity, we got there, we got comfortable with the virtual world eventually. And then the question really shifted to, an analysis of what types of COVID growth curves are inbounds for us and what are out of bounds. Because, as we've all seen, there's almost no businesses through this period that have followed a linear, path and are sort of perfectly on their budget. It's been plus or minus pretty significantly. So we kind of placed the opportunity set into 3 buckets that sort of allowed us to filter, how we're, pursuing the plethora of opportunities and where we're spending time. And so the first bucket is what was kind of clearly out of bounds for us and continues to be. So given all the prolonged uncertainty, we were pretty quick for our strategy anyway to put aside any business that had been fundamentally and deeply impacted by shutdowns, reduced demand. So, for example, the hospitality sector, we kind of said, let's leave that for the distressed world. There's probably tons of money to be made, but we're just not prepared to make a bet on when and what post-COVID normal would actually be, despite the fact that is the specific topic of our panel here. When are things going to end? When are diners going to come back? What capacity? It's just way too macro for our strategy. So we kind of said, that's just not stuff we're going to touch. Then there's the bucket of things that of investments that have been severely impacted, but not to an existential degree. So think, a beauty brand with Sephora concentration. We believe Sephora will certainly make it through to the other side. It's critical to the ecosystem, but that brand has lost momentum. And so unless there's a desperate need for cash, there's going to be an inherent disconnect with the founders around a valuation discount, because no one in that seat wants to look at their business as less valuable than it was 6 months ago, and most people think that COVID is temporal when they sit in that seat. So there we really only focus pretty selectively on brands that we thought could really get to the other side and get out of this, but where there was going to be a true need for capital, and therefore there's going to be a reasonable conversation around valuation. And so, we managed to pick off a couple, kind of in that subset that we're pretty excited about, that there was a moment in time. But really the third bucket is all the fun stuff and where we've been spending the lion's share of our time. And that's really, there's a lot of businesses that have actually in the consumer space seen explosive growth during these past 6 months. And really it's due to the shift in consumer preferences and purchasing behavior. And so the analysis here is much more about how much of that growth is sustainable. And for us, that sustainability is assessed by looking at, are these shifts temporal or fundamental, even if inflated? And so the most widespread conundrum is with e-commerce brands, I'm sure everyone is aware, and a much bigger participant in the e-commerce ecosystem. We're certainly comfortable with the assertion that COVID has pushed e-commerce adoption curve several years up its sort of penetration curve ultimately. But will CAC always look this good, and how might that vary based on the use case for an e-commerce purchase? So for us, that this test ultimately comes down to were the economics unit economics working pre-COVID. And if it was pretty questionable then, we're not willing to make the bet that the new normal has forever changed that business and their business model. I think what we are very excited about is, any business where the unit economics were at least marginally working pre-COVID, and now they're just absolutely killing it. Then it's kind of a let's go, because the new normal is probably somewhere between those two bookends, and anywhere between those bookends is a business that's probably going to work and we can get pretty excited about. And so that's really largely where we spend a lot of time and how we sort of cut out the universe.
Got it. Eric, Pat, Kristen, anything to pile on with?
Yeah, it's Eric. I think those are all really well stated points of view. We saw, particularly in e-commerce businesses, when you saw some of the larger retailers pulling out of Google and Amazon with respect to advertising just to conserve cash, a lot of these nichier folks were able to, it was a gamble back then and it wasn't easy to do, but they started to see that the payback on the acquisition was diving down fast, and that the cost of acquisition was so much less. They were able to plow a lot more money in. And I think when you have a continuity type business that's lifetime value oriented, that's a smart move, because you can really get a bump in your customer file that could be permanent or long lasting. I think the challenge for folks in our shoes here as investors is trying to figure out where is that new normal between an extreme opportunity to really plow marketing dollars in and build your file versus what's the world going to look like in 2021. And we're still struggling with it. Frankly, the appetite, particularly in e-commerce, for home goods businesses that are just killing it. I'm sure everyone on the phone here and on the videos, changed out a fan, or got a new lamp, or got an area rug, or got some wall art, or you name it. And those are capital goods in many ways. You're not going to buy 20 of them. So how do you think about that pop and the pull forward versus just the notion of e-commerce, being a more regular way of shopping today, and what that does to demand in 2021. We spend a lot of time thinking about what does 2021 look like, and given the current trends in the U.S., we may be thinking about what does 2022 look like.
Yeah, I think just building off of your comment, this really starts with the consumer. I don't think we've ever had to have more focus on consumer behavior and its evolution through this crisis. And, a year ago, joining, investing in gyms seemed like the absolute best investment one could do. They're not looking so good right now. Yet understanding how, as you mentioned, how home improvement projects work. Think about how consumers are dealing with the isolation of COVID and being in their homes, and pet ownership is through the roof. That category is growing to $90 billion of pet services, and ownership is up very high. And frankly, when we all have to go back to work, we're going to have to find some way to keep Rover busy. And so the services that flow from that. So, from our perspective, all the things that Oliver said, I think are spot on. It's about now, going to where the puck is going to be as it relates to consumers, and identifying businesses that will be very relevant coming out of this.
Yeah, no, all great points. And on the pet space, actually, Kristen and I worked on a pet deal that closed a couple of months ago. So that's one that's near and dear to our heart as well. Pat, just continuing down the road that you were on. Retail is interesting these days, right? It's depending where you are, it's got some challenges, but certainly got some opportunities. As you sit where you are with the role that you have, I heard you mention gyms. I heard you make reference at least to doggy daycare or doggy hosting and the like. What excites you from a multi-unit kind of build strategy here and now?
Yes, I think the reality is if you follow the consumer and how they're behaving, certainly. We see a shift within the food space. We're ordering online. We mentioned, digital services, third-party delivery, online ordering, curbside pickup. We've changed our behavior without question, and that has driven a significant amount of the business. in the restaurant space, which we're very fond of. And the really good performers have found a way to innovate. I mean, right now, management, in my entire career, the premium that you put on management as you assess the value of a business has never been higher. And they've had the ultimate stress test over the last 8 months to see how they can innovate through the crisis, how they can position themselves for success. And why that's so important is the COVID crisis will end. Whether it's June of 2021, whatever you're underwriting, or later or sooner, the reality is it will end. And when it does, what we do know is that there'll be, from a supply and demand perspective, the supply of locations, and certainly in the restaurant space, numbers coming out of National Restaurant Association are as high as 25 to 30% of doors will close. Well, I don't believe that the demand for restaurants and eating out will decline. We believe it'll return. And so we feel very good about the opportunities for those that can not only survive, but thrive coming through COVID. There'll be less competition. Many of the headwinds that the industry experienced going into COVID, labor challenges, occupancy costs, those will now become tailwinds. And so we feel very optimistic about that space as well.
Got it. Makes sense. Eric, you obviously have a broad perspective sitting where you are, and you've also got an interesting perspective, being both a recovering attorney and a recovering investment banker before becoming a private equity investor. Oliver referenced accelerating adoption curves and what have you. And as part of my due diligence preparing for this panel, I actually came across a piece that you had written on baby boomers, right? And their adoption of e-commerce in particular, and in particular over the past 6 months or so, without perhaps without perhaps getting too pedantic in terms of the findings from that, but anything interesting to say with respect to particular cohorts and what you're seeing there with respect to opportunities and/or challenges?
Sure, Craig. So I think first of all, and this will be an obvious statement, but all boomers are not necessarily created equally. Meaning, the 55-year-old person is going to be very different in their habits and outlook than someone who's 75. And where that continuum kind of crosses over is anyone's guess. But as a general group, the Boomer Plus has over 70% of the disposable income in the U.S. and something like 5 to 8% of marketing dollars are targeted toward them. So they're a pretty underserved demographic in many ways. And I think what we're seeing and what a lot of the data is showing is that a lot of the adoption of online shopping has accelerated for them, first and foremost, more than almost anyone, because principally they're among the most at risk, particularly as you go up in the age cohort with respect to COVID. And so, I think what'll be interesting to see is how are online brands able to be a little bit sharper and more thoughtful and perhaps subtle in marketing to that consumer without necessarily alienating a core. I think most boomers think of themselves more as a psychographic, and you're talking about a mentality as opposed to an age, being healthy and active and thinking of themselves as people that are out there being athletically competitive, certainly well into their 60s and in some cases into their 70s with tennis and golf. So to me, them not wanting to go into the store, take the chance, is something I think is going to continue for quite a while. And at a certain point, that habit just becomes part of who you are. I agree with Pat that at some point this will end. I think the end point for them, or the risk, is going to be a little bit longer out in time, which really means, are they going to want to be in stores versus shopping online? I think what you're seeing is a lot more online browsing and searching and buying. And I think that the data would suggest that those habits are going to be more ingrained going forward. And so there is that opportunity. And look, for the guys who are really more brick and mortar retail, that really just goes to buy online and pick up in store, curbside for that demographic, which I think you're seeing certainly a lot better service with respect to guys like Target and Walmart. But to me, the real opportunity, including even more broadly, is just for some of these niche brands. Before COVID, something like 85% of all search for products started on Amazon or Google. And what you're seeing now, or what you saw post-COVID after shelter in place at least, was that 14% that went to niche direct retailers has almost doubled to 27%. And so what that means is people are willing to try other brands. They're kind of tired of waiting for Amazon to ship them in 2 weeks, or they're not feeling like they're getting what they want on Google, and they're hearing about and sampling more. And so I do think there's an opportunity for some of these niche brands to appeal certainly more broadly, but also to that boomer demographic more effectively.
Got it. And I do want to come back to valuation, broadly speaking, because I've heard that referenced a number of times here, but perhaps just switching gears here. Kristen, as the lone legal beagle on the horn, you obviously see you see a lot of deal flow in general, but within the consumer sector, from a legal perspective, what are you seeing? And how has the allocation of risk or not, been altered here under COVID? Where are you seeing areas of opportunity just in terms of the deals that are flowing across your desk? Or, interestingly as well, I think you probably have a good line of sight into challenging industries, just given the work that you all do with companies in distress and what have you.
Yeah, and I want to echo what Oliver, Pat, and Eric are saying in terms of not knowing when COVID will end. And I know that our audience probably saw the title of our segment and said, "Ooh, they know something we don't. They know post-COVID." But along with, I think, our spirit of the world, my crystal ball died and broke in March. And I think everybody, if you're reading articles now, they're saying that they had projected that the world will be back to normal, people will be back in school and in the offices by September. And that's obviously not the case. And so, as Pat mentioned, are you underwriting for 2021? Is it 2022? That's something we can't predict at this point. But what I would say is that, from our perspective, it's really 3 buckets temporally. We have transactions that were sort of chugging along pre-COVID, that weren't quite yet signed when the shelter in place was ordered. We also have transactions that were signed up, let's say Q4 of 2019, and I'm sure everybody in this group and in the room has been watching to see how the Tiffany's case is going to unfold at some point, but I'll go back to that. But that's a illustration of a deal that's signed in 2019 with a particular agreed upon valuation, how it was doing in the market. Then, Q1, Q2, things kind of, bombed in revenues. And then there became this new theme. And instead of 2020 being just a dumpster fire, it's more of buyers trying to figure out how to get out of their transactions by claiming material adverse effect on their deal, or that the business wasn't operating in the ordinary course as it should have been, because that's not the business we wanted to buy and signed up to buy in 2019. So we have those transactions. And then, as these guys are saying, people are looking at what's out there in terms of kinds of deals that can be made, add-ons, things like that. My role is not to advise our clients, obviously, and whether or not to deploy the dry powder and do an add-on acquisition. But we do have clients that are really paying attention to all of the retailers who are filing for bankruptcy and protection and potential 363 asset sales, things like that. So people are watching, paying attention, and being very thoughtful about what their next deployment of capital might be. And then we can go back to it in a bit. I don't want to take over the conversation about the legality of it, but really looking at where we are in the deal is going to make a huge difference as to what's going to be happening in the future. But for new deals, new engagement, things like that, the landscape's going to look very different, I think, for papering it anyway.
Got it. Good stuff. And so before we roll into the next question or topic, I just want to apprise the audience or remind them, to the extent you do have questions, the microphone is open. The Q&A function on your website, which, to the extent you have a question, feel free to lob it in, and we'll do our best to address it. A number of you have touched upon this already, and it's clearly, you know, a significant component of evaluating any deal here and now. You know, in terms of valuation, how are you thinking about that in general? And I say that largely from the perspective of, again, you're never really getting a still shot, or it's tougher to get a still shot in this fluid environment. And as an investment banker, right, one of our favorite line items, if not the favorite line item on the P&L, is the non-GAAP add back line item, which can cut both ways these days, right? I mean, you've got, you know, COVID add backs related to, you know, business models getting hammered, perhaps most acutely in the dark days, be it, you know, March, April, May, but even ongoing. And on the, you know, on the flip side, you also have, you know, normalizations, right? Where to the extent you were a product that was sold through grocery in March and April, well, you probably outperformed just because your distribution was deemed essential everywhere, and you know, the consumer had access to your product. So, you know, as you all are looking at businesses, how are you thinking about valuation, and how are you kind of balancing the, you know, the various perhaps counterweights at play? Oliver, maybe I'll start with you, just
Sure.
given your volume over the past couple months.
Yeah, I mean, I think it's I think we all hoped that there would be a real buying opportunity and the multiples would contract. And I think in a couple of those middle ground cases I laid out, you know, we were able to find some for a little bit, but generally, from a multiples perspective, it's sort of unfortunately been kind of smooth sailing and remains pretty rich overall. And in fact, maybe even gotten richer because of, you know, the alternative of the public markets and the hope that, you know, high growth emerging brands, you know, VC backed brands, you know, have for following that path, and just exactly how good it could be, you know, in terms of hitting a home run. So I think really that's been tough. I think really where we focus more, you know, to your point, is what's the multiple off of, and therefore, you know, what is sort of the normalized level of revenue or profitability or whatever the right metric is for that business. And there it has been a lot of sort of looking at, you know, taking out the peaks of COVID, you know, taking out those like dark days of April, May, June, and really trying to trend line what things have looked like without that. And then kind of comparing that to the year-over-year growth rates. But it's honestly been much more of art than science to try to, you know, come up with that, particularly for the types of, you know, more emerging brands we look at and work with. I think, you know, one challenge for us, and just, you know, kind of adding to what Eric was talking a little bit about, the e-commerce world and where it's going, and this kind of factors into valuations and normalization, is, you know, yes, the curve is pushed forward quite a bit, but a lot of our assessment of what the new normal is about what types of products will continue to be bought online and what won't in those numbers. So, you know, in the extreme, if you've now started buying your pet food on Chewy, well, to us, that's probably not going back to retail, right? That's probably like, that's just a much more convenient way of purchasing your food. It's the same brand. However, if you're now buying your lamp or your furniture, as Eric was talking about, on Wayfair, you might be doing that because, yes, that's a big purchase, but you don't want to go to the store, right? That may come back into retail more likely. And so we're less likely to normalize a business where the purchasing behavior, we feel like, has less of a chance to come back into retail or to come back into another channel. The other thing which is interesting, and you know, maybe not counterintuitive now that we understand it, but, you know, not all sort of food brands, for example, have actually done that well. So we're in, you know, food categories. The category has been great. We invest in a lot of, you know, emerging brands, and a lot of that is about discovery. Well, unfortunately, you know, buying your groceries on Instacart or Amazon is really not a great discovery process today. I'm sure that will change. I'm sure they'll innovate, but you're going on there, you're proactively seeking what you want, and you're not able to browse options. So those emerging brands actually aren't getting found in the same way. And then similarly, when you're going into the store, you're not hanging around in the aisles anymore, like trying to check out something new. You got a list, you're getting out quickly. And so a lot of those brands, if anything, I mean, they haven't done terribly, but haven't done as well as you would expect. And so really sometimes the normalization is actually the other way, even though the overall food category has been up a little bit. So I guess my point is saying it's really idiosyncratic. You got to take every business and every category for what it is and just really do your best to put your mind in that of the consumer and what will things look like in 2021, 2022, whatever that other side of COVID is that everyone's talking about.
Well, I agree with that point. I think one thing we've seen because of that sophisticated view you're talking about, there's some real big valuation gaps out there. Because one thing we haven't seen is the seller's expectations, moderate, even when we can show, mathematically that, your cost of acquisitions, 20% of what it was 6 months ago, and geez, can that last? Or you're selling $2,000 sofas because the government is stimulating the economy like never before. Can that last? And of course, the answer is from them, yes, we've taken the floor here, and the floor now is here, and you're welcome. And we don't sit on the inside, so we don't know what they know, and we're naturally supposed to be, not skeptical, but certainly poking at some of these things. And so, Oliver, I think it's a great point, because some of those categories where there's likely to be reversion to the mean over time, we're not seeing it from the seller's perspective. And amazingly, we're seeing enormous deal flow, particularly entrepreneurs, where we're putting in bids adjusted, I think, appropriately for some of those dynamics. And we're just getting blown to Mars. I think it'll be interesting to see what happens with those deals over the next 2 months, if they get done or not, because there are a lot of them out there with pretty big valuation right now. And I think places where there is likely to be moderation in terms of demand over time, exactly your point, Oliver.
Yeah, if you look at the lower middle market, we deal with a lot of founders, and you're right. Their position is that they're feeling pretty good. We made it through the worst part of COVID. Well, there's a thing called PPP, and there's $10 million of cash. It's on your balance sheet that wouldn't have been there had it not been for the government. And you may not get that one in the next go around. And so, the conversations we're having, with founders is we believe in the brand, or we wouldn't be having this conversation. But frankly, you're picking the worst time to sell a business, and you're going to have to share that risk. And so we are, as a strategy, saying, look, we're going to take a control position, but you're going to keep a meaningful position. And between earnouts, and keeping a meaningful stake in the company, we think that's the way to basically appropriately share that risk that they own completely now. Because what's crucial is without a PPP, it's crucial that these businesses have enough cash on the balance sheet to come out of COVID running, not limping. And we think that's worth, diluting their equity for that kind of capability. We believe the second bite at the apple, and that's the case we're making, will be much stronger. And they should, take, an earn out or some equity piece as well.
Pat, how many businesses are you guys looking at that are recipients of a PPP loan? Because that's something I would highlight in our legal diligence, and as being one of the not a red flag, but a caution, because especially VC-backed private equity buyers, and how the impact of being part of a PPP loan process program could be a very big negative, and might require a payoff at closing rather than applying for forgiveness at some point in the future. What are you seeing for recipients?
In the lower middle market, across the board, they've taken PPP, and why not? If you had a good banking relationship, getting PPP was quite simple, and so what we're finding out is most of them have been pretty responsible in terms of keeping separate bank accounts, and they're tracking that, and are feeling very confident that it will all be forgiven. And so I think they're managing it well. Their bankers are managing it well from our early conversations with their bankers. It's certainly a key part of diligence on the couple of LOIs we're working on right now. because it's a game changer for sure. But I think the real question is not the rearview mirror, but going out, the front windshield. And that is, if with the second wave, are they going to get the PPP? And obviously, we'll get a better indication in a week or so. But clearly, that is something that has buoyed the valuation and quite frankly, the optimism of the operators. Hey, we did a great job making it through COVID. You got 10 million and you've got 7 million of cash in your balance sheet. Yeah, there's risk out there to deal with.
That's a great point. Just Kristen, from the legal side of things, what are you seeing with? And I know we kind of touched upon it a little bit already, but just structural mechanisms that are put in place to bridge valuation gaps, right? Whether it's earnouts or seller paper or just frankly more onerous language in the contracts, et cetera.
It's interesting, Craig, because we had in the summertime that there was a slight purchase price adjustment, but otherwise we didn't do much adjusting with earnouts and things like that. There's a lot of discussion about, is it going to be measured again? The targets, what are they going to be, and how is that being impacted? But it was sort of in an industry, in the retail industry, that wasn't getting hammered, and it was a little bit more stable than maybe some of the other in-store brick and mortar type of businesses. So that was interesting. But looking forward in transactions that might be out there, it's going to be tricky in terms of what are we going to base it on? Is the earnout going to be on your EBITDA and things like that? Other things of control and who's going to have say in how you're operating the business going forward. Is the management really, how big is the rollover? How much involvement is there going to be? Things like that. And I think somebody had said it, value is being put more heavily on management now and looking at transactions and how the businesses are being run. I'm trying to think of, as part of the process and thinking about, measuring your revenues and going forward. I think that a lot of the litigation that we're seeing now, there's been a huge dip in revenues. I don't think people were willing to wait out and see what happens. It was more of a Q by Q analysis instead of, okay, this is going to be a 12-month forecast and see what's happening. People are just getting too itchy and nervous, and we're pulling the plugs and trying to get out whatever they were negotiating at this point. But interestingly, going forward, we'll have to see in how aggressive our buyers are going to be, and like I think someone had mentioned, sellers aren't really moving off their points of valuation. So it's going to be an interesting back and forth, and whether or not how quickly people can get into some middle ground of agreement on what are we seeing in the future, and whether it is going to be based on the same metric that we've typically done.
Sure. I'm glancing at the clock, and I think we've got about 5 minutes left. So again, folks in the audience, if you have a question, let us know. As we're, or in the absence of that, or as we're waiting.
We got one.
What just popped up here? I got a little bit of delayed feed here. So the question is, legal question on PPP. If a buyer is doing an asset deal and the seller took a PPP loan, if seller does not pay back loan post-closing, is there any legal recourse to the buyer? Kristen, I'm guessing.
I assume the legal question is directed at me. I'm not a PPP expert, and I don't know whether or not, doing a cherry pick asset purchase, and whether there's a successor liability with respect to PPP loans. So I don't know exactly the answer to that, but that's something to consider and check in, especially with our PPP experts, because they will know offhand. I'm pretty sure the government wants to make sure that transactions aren't being structured as asset deals to avoid repayment of PPP loans. So, there's also, I know, provisions, especially that came out, some guidance in earlier October with respect to a change of ownership. And so let me back up. I guess there is some guidance about change of ownership, if it's greater than 50% maybe of your assets, I forget what the exact percentage is, but it does trigger some sort of a notification from the lender to SBA. And what happens at that point, it might be, let's say if it is in fact an asset purchase, that a portion of the proceeds that would go for those assets might have to go into escrow, and the amount would be the entire amount of the loan until there is a request for forgiveness, in order to protect the SBA from forgiving a loan that would have otherwise maybe gone by, oops, sorry, we sold the business, we have no more money. So I think there is some guidance out there. Again, I'm not an expert on PPP, but we're seeing some impact, especially when there's some kind of restructuring, not just an asset purchase, but like, doing some debt restructuring and things like that.
Yeah, obviously a complex topic that is playing out real time. And so it looks like we've got about 3 or 4 minutes, and we just got the question I was waiting for somebody to ask, which has to do with a small certain occurrence happening next week, which is how does the panel think election results will impact consumer behavior in the coming years? I'm not going to direct that at anybody in particular, but if anybody wants to give it a whirl, please do. And again, just be mindful, we've got about 2 minutes.
All right, I'll jump in. I think the answer is, again, at some point there's a reversion to the mean. At least I hope there is in a lot of different places in the United States these days, just in terms of behaviors, consumer or otherwise. I think in the short term, there could be a lot of volatility, but I would imagine that gets driven more by current COVID surges and what happens over the course of the winter in terms of lockdowns or economic volatility. I think in the longer term, I don't know if that's 2021 or 2022, I think you do get back to a more regular, normal cadence of consumer demand with a lot less volatility going forward. But I think we're looking at a pretty rocky ride from here to the end of the year and probably into the spring, with more not just stock market volatility, but I would expect credit market volatility, potential political volatility, and no one likes that, because you can box risk, but you can't really box the unknown. And I think there's certainly going to continue to be a lot of unknown over the next 3 to 4 months.
I would agree with that. So TJ, I saw you just popped up. I'm guessing you're giving us the 2-minute warning here.
Yes, I did. I'm back on. Thank you all very much for a great discussion. I think this panel certainly could go on for the better part of the day, based on all the changes that are afoot here. But I want to thank you, Craig, as well as Kristen, Eric, Oliver, and Pat for your very insightful comments. And we're all unfortunately going to have to wait and see how all this plays out. But again, thank you very much for your participation today. Just to close this session, I just wanted to go through a few housekeeping items with those in the general attendee office or audience. Throughout the next couple of days, this virtual ballroom that you're sitting in now, as well as the deal lounge, is where you're going to have all of your ad hoc meetings. There's some great guidance under the tech support and tips line over on the left-hand side underneath your profile, where you can get some help as needed. But most importantly, when this presentation ends, you can basically double click on a table or a floor and take you wherever it is that you want to go. All attendees that are participating in M&A East this year can schedule one-on-one meetings. We already have close to 2,200 meetings scheduled through our automated software. So continue to use that function, and hopefully you'll find some good conversations to come. You can search and request meetings through the navigation to the right of your screen, and be sure to check the conference agenda as well for any additional sessions that may be of interest to you. This afternoon at 3:30 Eastern is our SaaS and tech-enabled services panel, so it'll be a similar moderated panel as you just saw here on the consumer front. As well, should you have any questions, the ACG staff can be found at the help tables on the first floor of our ballroom, so feel free to drop in and say hello to them, or if you have any questions as to how to navigate around, they are there to help you, as well as with technical challenges you may be having. And just in closing, while everything is so different this year, we still hope you have a very efficient couple of days, and really appreciate you all joining us, and hope you all enjoy this year's M&A East Conference. Thank you very much.
Thank you.
Thank you.